It's securing funding. It's the moment when most ambitious real estate investors really just slam into a wall, isn't it?
It really is.
You found the perfect deal, the numbers look phenomenal, but then, the bank requires this mountainous down payment.
Yeah.
Your personal debt-to-income ratio gets scrutinized down to the penny, and the whole conventional process, it just feels designed to stop any forward momentum.
And that feeling of limitation, it's entirely accurate, unfortunately. The investor who sees the bank as the only source of funding is, well, by definition, accepting a ceiling on their potential.
Right.
They cap their ability to scale. They basically willingly settle for standard, often pretty pedestrian returns.
Our sources, thankfully, confirm a really powerful, critical truth here. The most successful, high-volume investors, the ones building genuine generational wealth, they don't just use banks.
No, not at all. They master unconventional deal structuring and, crucially, financial leverage. They start seeing money itself as like a tool to be engineered, not just some commodity you have to beg for.
So our mission today is really to give you that engineering playbook. We are diving deep into a stack of material that cuts right through the complexity of creative financing. We'll show you the essential mechanics and strategies, everything from maximizing leverage using, say, the BRRR method, to customizing debt terms with motivated sellers.
The goal is to fundamentally change the way you acquire property.
Exactly. This deep dive, it's designed to transform those conventional roadblocks, like maybe a lack of personal cash or getting rejected for a conventional loan.
Yeah, the deal killers.
Right. From deal killers into, well, challenging opportunities. The material we've looked at is absolutely clear. Creative financial strategy is paramount.
It's not just about finding money, then.
No, it's about shifting your entire perspective on how capital should operate. Let's jump in by anchoring ourselves in that necessary philosophy first. Okay, so the first step in this journey, and honestly, it's arguably the most difficult mental hurdle. It has absolutely nothing to do with property itself or interest rates.
Really? What is it, then? It's a core decision, prioritizing investing over consumption.
Okay, that sounds simple enough on the surface, but it's that constant grinding battle, isn't it?
Yeah.
The decision between capital versus consumption. Where does the source material suggest we draw the line on that?
It draws the line very aggressively. The foundation of true wealth, it argues, is built on valuing the growth of your capital machine more than immediate, short-term consumption gratification.
So becoming a millionaire real estate investor requires actual short-term sacrifices.
Absolutely. Tangible ones. Delaying the new car, maybe the upgrade trip, that luxury purchase you wanted, all for exponentially greater long-term gains.
So any extra income generated from our first few investments, that initial cash flow, the idea is it must not be spent, but poured right back into the machine.
Exactly. Reinvesting the lion's share of that cash flow into acquiring additional capital. That's the definition of creating a financial wealth-building machine that just feeds itself. If you spend that cash flow, you stay in the slow lane. If you reinvest it, the growth becomes, well, potentially exponential. You move from working for money to having your assets work for you, constantly compounding.
And this leads directly to the core mathematical principle that makes this whole philosophy actually function. Maximizing return on investment, ROI, specifically by mastering leverage. Now, I've heard the basic concept before, leverage, but let's get into the mechanics. How does financing more of the purchase price drastically increase the return on the capital I actually put in?
It's simple mathematics, really, but often overlooked. When you leverage, you are controlling a large appreciating asset with, relatively speaking, a small amount of your own money.
Okay.
Let's start with the basic example from the sources. Say you buy a house with $120,000 just at retail price, and you use conventional financing, maybe borrowing 80%. That requires a $24,000 down payment.
Okay, $24,000 cash out of pocket. Got it.
Now, let's assume for simplicity, the rental income merely covers the monthly mortgage, taxes, insurance, PICI. Your only profit in the first year comes just from simple appreciation.
Okay.
If the house appreciates by a very modest 5%, that's $6,000 in passive value gain.
Right. $6,000 on $120,000.
Yes, but here's the key. Since you only put in $24,000 of your own money, that $6,000 gain represents a stunning 25% return on your initial down payment.
Wow, 25% return on cash invested just for a standard plain vanilla deal. That's actually already pretty impressive.
It is. But this is where the creative financing intelligence kicks in. How do we get to those aggressive returns the sources talk about? 40%, 60%, maybe even 100% on that initial investment.
Yeah, how do we do that?
You combine leverage with forced appreciation and smart purchasing power. The sources really emphasize learning to buy properties below market price, maybe getting a 20% discount, and simultaneously financing more of the deal, usually through specialized non-conventional loans or, as we'll discuss, seller financing. You front-load your returns that way.
So that immediate equity gain from buying low combined with the extreme leverage on my down payment. That's the magic.
That combination can deliver that 40 to 100% return in the first few years. Yes, it's aggressive leverage working for you.
But it needs to be repeatable, right? You can't just do one amazing deal.
Yeah.
And that brings us to that acronym every serious investor seems to need to know, BRRR.
Yes, BRRR.
Buy, rehab, rent, refinance, repeat. Let's detail the mechanism there. How do you use that equity to continually fund new deals?
The BRRR cycle is, well, it's the blueprint for exponential growth, precisely because it allows you to recycle your initial cash. It breaks down like this. First, you buy a distressed or undervalued property.
Got it. Buy low.
Second, you rehab it, forcing its value significantly higher through improvements. Third, you rent it out, establishing it as a cash-flowing asset.
Okay, standard enough so far.
But the fourth step, refinance, that's the real game changer.
Okay, unpack that refinance step for us. We're refinancing the property at its new, higher, improved value. How does that actually translate into cash for the next deal?
Right. So a lender will look at the new appraised value, say it's $150,000 now after rehab. They'll typically lend you 75% or maybe 80% of that figure.
Okay, based on the new value.
Exactly. And because that loan is based on the new higher value and your initial purchase price plus rehab costs were lower, the new loan amount often exceeds what you have into the property.
I see.
The excess cash you receive from that refinance, the loan proceeds, that becomes the critical funding for your next deal, your next buy.
And here's the crucial tax nugget we need to emphasize, which the original script completely glossed over. That funding, that cash you pull out for the new project, is tax-free. Why is that?
This is often misunderstood. That money is tax-free simply because loan proceeds are not considered taxable income by the IRS.
You haven't earned it, you borrowed it.
Precisely. You aren't earning income, you are incurring debt. You're just replacing one form of debt, like your initial purchase and rehab funding, maybe short-term hard money, with a new, larger, longer-term form of debt based on the asset's improved collateral value.
So you've successfully pulled your original cash, maybe even some profit, out of the deal without triggering a taxable event.
That's what we call tax-intelligent recapitalization, and it's key to the repeat part of BRRRR.
That clarity is absolutely essential. Okay, so we have this potential exponential wealth machine, but it clearly requires massive capital access over time. Which brings us back to that contrast between my personal financial constraints and my potential commercial power.
Exactly. Your ability to scale is entirely dependent on understanding the difference between your personal credit limits and your commercial borrowing power. For a commercial investor, the borrowing power will, or at least can, vastly exceed their personal qualifying power.
Why is that? What's the shift?
Because the lending decision shifts focus. It moves almost entirely away from the borrower's personal W-2 income and focuses instead on the projected rental revenues and the performance of the asset itself. The property has to stand on its own.
The sources provided a really stunning illustration of this principle. They cited an investor earning, $51,350 annually from her day job. Respectable, but, fairly modest income.
Yeah.
Yet she was servicing $26,430 monthly in mortgage payments across her portfolio.
That is only possible because those mortgages are financed solely by the rental revenues she collects across all her properties. The asset portfolio's performance is the collateral and really the primary qualification factor.
So her commercial borrowing power, her ability to acquire more revenue-generating assets, just blew past her ability to qualify based on her personal paycheck alone.
Absolutely. And that mindset shift, seeing your portfolio as the engine, not your job, that's the defining difference between a hobbyist investor and someone building a real estate enterprise.
Okay, we've established the mindset and the math behind leverage and ROI.
Yeah.
The big question remains, though. How do we actually acquire those first few properties, or even later ones, when the traditional bank maybe says no or the terms just don't work?
Right.
Let's move into implementing these creative deal structures, starting with a real classic,
Ah,
seller financing.
seller financing. Yes, it's one of the oldest and frankly most powerful tools for buying property using little or perhaps even no money down out of your own pocket.
How does it work, basically?
In this structure, the property owner essentially acts as the bank. They accept a down payment, sometimes small, sometimes zero, and then they take payments directly from you, the buyer, over an agreed upon term, rate, and schedule.
You mentioned it dipped in popularity.
Yeah, it did during periods of, ultra low interest rates and what they called easy credit. If banks were giving money away, why bother negotiating with the seller?
Makes sense.
But it is absolutely surging back now as interest rates have stabilized at higher levels. Sellers are more motivated.
But I imagine securing seller financing isn't just luck. It's probably less about luck and more about strategic negotiation, right? It can't just be about asking the seller, hey, will you hold the note, can it?
Oh, absolutely not. That's where most novices fail, honestly. They focus intensely, almost solely, on the purchase price.
Which seems logical.
It does, but price is only one element of the negotiation. The material we reviewed is explicit on this. The terms of any owner financing. That means the interest rate, the amortization period, the term length, any balloon payment structure, the actual monthly payments, all that must be carefully negotiated before you make the actual offer.
Before the offer, why is negotiating the terms first so critical?
Because the terms dictate your cash flow and your risk profile. Think about it. You might actually be willing to pay slightly above market price if the seller agrees to, say, 0% interest for 5 years.
Wow, yeah, that would dramatically improve immediate cash flow.
Exactly. Conversely, getting a property below market price might be totally worthless if the seller insists on something crazy like a 6-month balloon payment that you know you can't meet or refinance in time. The terms are the deal, often more than the price.
And successful negotiation, as you hinted, requires understanding the seller's motivation, finding their pain point. What should we be looking for beyond the obvious, like they just need cash?
Often it revolves around tax benefits, especially with older property owners who've held the property for a long, long time.
Okay.
Many people who have held property for decades are sitting on massive unrealized capital gains. If they sell for all cash, they face an immediate, potentially huge appreciation tax bill.
And that fear often causes paralysis, right?
Yeah.
A reluctance to sell at all, even if they desperately want to retire or move on.
Precisely. And that hesitation, that tax burden problem, is the exact opportunity the savvy buyer needs.
So how do you leverage that?
By highlighting the potential tax benefits available to the seller in a seller finance deal, you show them how it provides them with the answer they need, instead of a crushing tax liability up front.
They get payments over time.
Exactly. They receive predictable payments over a fixed term, potentially softening the tax burden significantly by spreading the income, that capital gain, over multiple years using the installment sale method. You are literally solving the seller's problem.
And that financial intelligence, solving their problem, becomes the advantage the buyer requires to get the deal done on favorable terms.
That's the essence of creative win-win negotiation.
That's a really sophisticated angle. But okay, what happens when we've identified the property? Maybe we've even started talking terms with the seller, but the required loan amount, even with seller financing, is still just too high for the deal to comfortably cash flow. Maybe the rents are low or expenses are high initially.
That's the moment for creative debt customization. If the total debt required, whether it's seller financing or maybe a combination, exceeds what the projected rental revenues can reasonably support,
Yeah.
the investor cannot just give up. They need to find a way to structure the debt so that part of the purchase price is borrowed at a lower rate, or maybe with lower payments initially, or perhaps even with deferred payments entirely for a period.
Okay, give me an example of how that calculation might work in practice. How do you engineer that?
Well, you essentially start by running the cash flow projection backwards. Let's say the property generates $1,500 in gross rent per month, and after accounting for operating expenses, vacancy, etc., you determine you need the total mortgage payment, or payments, to be no more than $800 to hit your target cash flow number.
Okay, $800 max payment.
You then calculate what combination of interest rate and term length is required to generate that $800 payment on the negotiated purchase price or loan amount. If a standard, say, 7% interest rate results in a $1,000 payment.
It doesn't work.
Right, it doesn't work. So you must then go back and negotiate maybe a 4% rate with the seller on their portion, or perhaps you ask the seller to defer $200 of their payment each month until year 3, when you anticipate rents will be higher.
Or maybe wrap a secondary loan.
Or potentially wrap a secondary loan structure into the deal at a lower rate from a third party, like a private lender.
Yeah.
You are actively engineering the debt structure to fit the financial reality of that specific asset at that specific time.
That requires some pretty deep financial modeling before even shaking hands or signing anything.
Absolutely. Due diligence isn't just the physical property, it's the financial structure.
Now, speaking of complex deals, let's talk about situations involving multiple parties, like properties tied up in an estate sale or a messy divorce, or maybe a partnership dissolving. That just sounds like an instant negotiation breakdown waiting to happen.
It definitely can be a minefield if you approach it conventionally, trying
Yeah.
to get everyone on the same page at the same price and terms simultaneously.
So how do you handle it?
The sources provide a really smart structural solution. The savvy investor makes the initial offer, maybe a letter of intent, subject to being able to buy out the other parties on terms agreeable to you, the buyer.
So you're setting the stage explicitly for separate negotiations based on each party's individual needs.
Precisely. You're not trying to force a one-size-fits-all solution onto people with potentially very different motivations and financial situations.
Okay, let's say I'm dealing with 3 different partners or heirs in an estate sale. How do I structure that initial non-binding offer to keep my leverage and, frankly, not scare them off by seeming too complicated?
The initial offer needs to be clear that it's for the entire property. You want the whole asset. But, crucially, it should state that the method of payment for the shares held by the different parties is flexible and will be negotiated individually.
So you're signaling, I want the whole thing, and I am prepared to meet the needs of each of you sellers individually to make that happen.
Exactly. This is crucial because, as we know, different parties almost always have different liquidity needs and tax situations.
Which explains why the sources note you might actually end up paying a slightly different effective price or buying on completely different terms for the different parties involved.
Absolutely. One beneficiary in that estate, maybe they need immediate cash to pay off medical bills or something. They might happily accept, say, 90 cents on the dollar for their share's value just for the speed and certainty of immediate liquidity.
While another might be fine waiting.
Right. Another beneficiary might be financially stable. Maybe they're more concerned about taxes or just want a higher total return over time. They might be perfectly willing to accept seller financing terms from you, maybe carrying a 5% note for 5 years, realizing those installment sale tax benefits and getting steady income.
So by customizing the debt structure and the payoff based on each seller's individual need, you turn a complex multi-party deal from what seems like a chaotic problem into a multi-layered opportunity.
That's advanced deal structuring. You solve their problems to create your opportunity.
Okay, even when we master these creative techniques like seller financing, let's face it, professional lenders, banks, credit unions, they're still a necessary piece of the puzzle, aren't they?
Oh, absolutely. Especially for that critical refinance step in BRRR, or certainly when you start scaling up to larger commercial portfolio loans.
So we need to understand the absolute first metrics they prioritize when looking at an investment deal. What's number one?
Without a doubt, the single most critical metric is the loan-to-value ratio, or LTV.
LTV. Okay.
This ratio tells the lender exactly how much equity cushion they have in the property relative to the loan amount they're giving you. Think of it as their safety margin.
Right. So if the market takes a dip, say 15%, the lender wants to know they won't immediately be underwater on the loan.
Precisely. They want skin in the game from you.
So what LTV ratio should we typically expect professional lenders to look for when it comes to investment property, which they generally view as riskier than, say, a primary residence?
Yeah, for non-owner-occupied investment property, lenders are definitely more conservative. They generally seek an LTV of less than 80%. But honestly, 70% or even 75% is quite common, especially for commercial portfolio lenders or for cash-out refinances.
So a lower LTV, meaning you have more of your own equity tied up in the deal.
Signals safety to the lender and typically results in better interest rates and terms for you, the borrower. It tells the bank you're committed and less likely to walk away if things get tough.
Makes sense. Beyond that equity cushion, the LTV, what other safety mechanism does the lender often bake into the loan documents to protect their income stream if the property's cash flow falters for some reason?
Oh.
The sources mention something called an assignment of rents.
Yes, the assignment of rents. This is a critical legal detail, often buried in the loan docs that investors need to understand.
What does it do?
An assignment of rents clause, which is often mandatory in investment property loans, basically gives the lender the legal right to bypass the borrower entirely.
Bypass me.
Yes, bypass you and collect rent directly from the tenants if you, the borrower, default on the loan payments.
Wow. So they just step in and take the rent.
It's the bank's immediate security blanket for the income stream securing their loan.
What are the practical consequences of that for me as the investor if that clause gets triggered?
Well, first and foremost, you lose immediate control of the property's income stream. The rent money goes straight to the lender to cover the debt service.
Okay.
And while it might prevent the need for an immediate, costly foreclosure process for the bank, it signals that you, the investor, are in severe financial trouble. It can often lead to the lender accelerating the loan terms,
Yeah.
meaning they demand the full remaining balance of the loan be paid immediately. So it's a serious situation. It
Yeah.
really underscores the lender's absolute priority, preserving the cash flow to service their debt.
That makes perfect sense from their risk management perspective. Okay, another requirement that I think novice investors often overlook, maybe thinking the deal itself is all that matters, is liquidity. It's not enough to prove the property cash flows. I have to prove I have cash reserves.
Absolutely. This trips up a lot of people. Lenders demand to see financial resilience on your part personally. Liquidity requirements do vary between lenders and loan types. But most institutional lenders will require the borrower to demonstrate a minimum of, say, 6 to 9 months of the proposed mortgage payments, PITI, for that specific property.
6 to 9 months.
Wow.
Shown on your personal financial statement, held in accessible cash or cash equivalents like marketable securities.
Why so much? 6 to 9 months of mortgage payments seems like a lot, especially if the property is supposed to be paying for itself through rent.
Yes, but it accounts for market turbulence. What if you have an extended vacancy between tenants? What if there's a catastrophic repair needed, like a new roof immediately, or sudden unexpected property tax hikes?
Ah, the unknowns.
Right. If the property sits vacant for 3 months, the bank needs to know you can still comfortably pay the mortgage from your personal reserves, preventing a default.
Okay.
And some other lenders take a different approach, sometimes requiring as much as 10% of the total loan amount being requested to be held in cash reserves.
10% of the loan? Yeah, it can be a significant hurdle. This liquidity requirement is often a non-negotiable prerequisite for scaling your portfolio using professional debt. You have to prove you can weather storms.
So liquidity isn't just about surviving, it's a prerequisite for scaling.
Got it.
Got it. Now, let's pivot slightly. Let's talk about using those high ROI returns we discussed back in section 1. Once the wealth building machine starts, printing some money, should I prioritize paying off my existing debt faster? Or should I be aggressively reinvesting that capital?
Ah, the classic pay down debt versus reinvest dilemma. And this is where leverage math often defies conventional personal finance wisdom.
How so?
Well, think about it. If you make prepayments of principal on a loan that has, say, a 7% interest rate, you are effectively investing your money at a guaranteed 7% rate of return, risk-free.
Which sounds pretty good, right? 7% guaranteed.
It is good, it's safe, it's reliable, and it's excellent for conservative wealth preservation. No question.
But the goals we've been discussing here are more geared towards aggressive wealth creation, especially in the early stages.
Precisely. And if your skillfully structured, creatively financed leveraged deals are generating returns of 40%, 60%, or maybe even 100% on your invested capital during those first few critical years, then the marginal benefit of paying off that 7% debt early is, mathematically speaking, tiny compared to the exponential returns you could potentially get by immediately recycling that capital into a new high ROI deal.
So the opportunity cost is huge.
The time value of money, compounded at 40 or 60%, will drastically outpace the guaranteed 7% savings from debt paydown. The sources strongly suggest using your high returns to fuel more high-return investments first.
And then use a resultant, hopefully massive profits generated later, to pay off loans faster, accelerating the entire wealth-building process.
Exactly. Maximize growth first, then consolidate and de-risk later once you've built significant equity and cash flow.
That's a powerful argument for maintaining maximum appropriate leverage, at least in the early high-growth stages. Now, for investors who do choose the prepayment route, maybe for peace of mind, simplicity, or just reducing risk, what was the practical tip the sources offered regarding managing those prepayments?
Yeah, keep the bookkeeping simple. This is important. Instead of trying to make slightly increased monthly payments, which can seriously complicate tracking principal versus interest and reconciling bank statements.
Right, trying to add an extra $50 or whatever.
Exactly. The advice is to keep careful records, maybe in a spreadsheet, and consider making one single larger prepayment of principal each year, or maybe quarterly.
How does that help?
You write a separate check or make a separate electronic payment clearly marked principal-only prepayment. This method is much cleaner for your own accounting, for tax purposes later, and for tracking your overall debt reduction timeline accurately with the lender. Simple is often better.
Okay, shifting gears one last time here. Let's look at some higher-level strategy. How can we potentially maximize our capital gains, our overall profit, by strategically targeting specific price points or maybe even different asset classes?
Right. The initial impulse for many new investors, and it's understandable, is often to chase the lowest priced houses available, the $80,000 or $100,000 range, maybe because the barrier to entry seems lower.
Yeah, less cash needed, less risk maybe.
That's the perception, but the problem is that's where like 90% of the competition resides. Every newbie, every wholesaler, every flipper is looking at those deals.
That's crowded.
Very crowded. The sources actually recommend a somewhat counterintuitive strategy for those looking to scale faster, targeting more expensive properties.
But expensive. Why jump up in price range? Doesn't that mean higher risk, higher carrying costs, more required reserves like we just talked about?
It does, yes. But there's a flip side. These higher-end properties, maybe small multifamily buildings, commercial properties, or even just more expensive single-family homes in certain markets, they are significantly more illiquid.
Less liquid, meaning harder to sell quickly.
Exactly. And because they require more capital and often more expertise, they attract far fewer investors who are willing or able to commit that level of capital. The competition just dries up significantly.
Okay, less competition. So what's the benefit?
This lack of competition often results in much greater dollar discounts off the true market value. You might be able to negotiate a 20%, 30%, or sometimes even a 40% discount off the perceived value, especially if you find a seller who needs quick relief or has let the property deteriorate.
Okay, let's run a profit comparison to make this really concrete.
Sure. Let's say you find a great deal on an $80,000 house. Maybe you get a huge 25% discount. Buy it for $60K, put $20 in rehab so you're all in for $80K, and maybe it's worth $100K fixed up. Your gross profit before costs is $20,000. That's good money, no question.
Right, 20K profit.
But now consider a comparable great deal. Let's say the same 25% discount structure, but on a $240,000 property. Maybe it's a small apartment building or a larger house. That same percentage discount could potentially yield a $60,000 gross profit.
3 times the profit.
3 times the profit for arguably a similar amount of negotiation effort, maybe a bit more rehab complexity, but not 3 times the work. By controlling more valuable, less liquid real estate, the investor captures significantly greater dollar profits per deal, allowing faster scaling.
That definitely makes the work exponentially more valuable, assuming, as you said, you can manage the increased carrying costs and the higher risk associated with those bigger assets.
It's about finding your sweet spot.
Right. Speaking of working smarter, not just harder, let's move to tax intelligence. The material really emphasizes that the tax benefits in real estate are intentional, they're built into the code, but they are not accidental windfalls.
This is perhaps one of the most important takeaways for investors looking to move beyond the basics. The U.S. tax code is heavily, deliberately engineered to favor real estate investors and developers. But those benefits only materialize if the strategies are known ahead of time and implemented correctly. You absolutely cannot be reactive about taxes in this business. You must be proactive.
And this is where the difference between 2 key types of financial professionals becomes really stark. We need to distinguish clearly between a tax return preparer and a tax advisor.
Yes, the distinction is crucial for success. A tax return preparer is fundamentally reactive. You give them your shoebox of receipts or your QuickBooks file maybe in February or March.
Yeah.
They report on what already happened last year, fill out the forms correctly, and calculate your tax liability or refund based on past events.
Standard tax filing.
Right. A tax advisor, on the other hand, is proactive. They should be working with you throughout the year before you close transactions. They help you model the tax implications of potential purchases before you buy.
So they help structure things.
Exactly. They advise on entity structuring should this be in an LLC, a partnership, your personal name. They provide options to achieve better tax results before the money is spent or the deal is finalized. They look ahead.
And that proactive approach is what maximizes the possibility of leveraging powerful tools like depreciation, cost segregation studies, and strategic expense deductions.
Precisely.
And perhaps the most powerful tool mentioned in the sources for reducing W-2 or other ordinary income, at least for certain earners, is leveraging rental property losses. How does that work?
This is a massive, often misunderstood subsidy for mid-range income earners who invest in real estate. For investors whose modified adjusted gross income, or MANGI,
Okay.
is under $100,000, the IRS generally allows up to $25,000 of passive rental losses per year to be used to offset other non-passive or ordinary income.
And these losses are often paper losses, right?
Mhm.
Treated by things like depreciation.
Very often, yes. Depreciation is a non-cash expense deduction that reflects the theoretical wear and tear on the building. It can create a loss on paper even if the property is cash flowing positively in reality, and that paper loss can offset income like W-2 wages or pension checks.
Okay, so let's run the numbers again quickly. If I have, say, $90,000 of taxable W-2 income, and my rental properties generate $25,000 in these paper losses after depreciation.
Your total taxable income for the year drops down to $65,000.
That is huge. That's real money back in my pocket or available for reinvestment.
It is massive. It's a direct subsidy for investing. Now, there's a catch for higher income investors. That $25,000 allowance starts to phase out.
Okay, how does the phase-out work?
Between $100,000 and $150,000 of MAGI, the investor receives only a partial benefit. The $25,000 allowance is reduced. Once your MAGI exceeds $150,000,
It's gone.
the entire $25,000 allowance is phased out completely for that year. Those losses then become what are called suspended passive losses.
Suspended, what happens to them?
They're not lost forever. They get carried forward indefinitely and can be used to offset future passive income, like positive cash flow from rentals in later years, or they can be fully deducted when you eventually sell that specific property. But you don't get the immediate benefit against your W-2 income if you're over the $150K MAGI limit.
Okay, so if I'm earning above that $150,000 threshold, does the tax code just stop helping me with rental losses against my ordinary income? Or is there, a loophole or another level available to the really serious, maybe full-time enterprise investor?
There is absolutely a loophole, or rather a specific designation, and it's the next level of tax intelligence, achieving the real estate professional status, or REP status, in the eyes of the IRS.
Real estate professional, okay, what does that involve?
If an investor, or sometimes their spouse, can qualify as an REP, which generally requires spending more than 750 hours annually performing real estate trade or business activities.
750 hours, that's significant.
It is. And critically, you also have to prove that more than half of the total personal services you perform in all trades or businesses during the year are performed in real estate trades or businesses in which you materially participate.
So it basically has to be your primary focus.
For many, yes. But if you meet those tests, those rental property losses are reclassified. They go from being passive losses subject to the limits to active or non-passive losses.
What does that mean? Why is that reclassification so important?
It means they are no longer subject to the $25,000 limit or the $150,000 MGI phase-out. A qualifying real estate professional can potentially use unlimited rental losses to offset all of their other ordinary income,
Wow.
regardless of how high their W-2 income, business income, or investment income might be. That distinction is often the key to dramatic tax optimization for the high-income, serious real estate investor.
That detailed knowledge is absolutely essential for structuring one's overall financial picture as you scale. Okay, let's turn to one final, incredibly powerful tool the sources highlight for growing capital tax-free or tax-deferred, using retirement funds for real estate.
Yes, the self-directed retirement account. The core premise here is pretty revolutionary for many people who assume their 401k or IRA has to stay in stocks and bonds. The IRS actually has no restriction requiring retirement money to stay locked only in the stock market.
Really? So it is perfectly legal to use funds currently sitting in my 401k or IRA for direct real estate investing?
Yes, it is, provided you follow the rules.
Okay, how does one physically move that capital into a real estate deal? I mean, I can't just write a check from my Fidelity IRA account to buy a duplex down the street, can I?
No, you can't do it directly like that. You need to utilize specialized financial institutions called self-directed retirement custodians or administrators.
Self-directed custodians, okay.
These companies hold the retirement funds, just like Fidelity or Vanguard might. But their platform allows the account owner, that's you, to direct where the money is invested. And those directions can include things like buying rental properties, issuing private mortgage notes, purchasing tax liens, and other alternative assets.
So this creates an avenue where the wealth generated from real estate, like the rental income, the appreciation when you sell, can grow and compound entirely tax-free within a Roth structure or tax-deferred within a traditional IRA or 401k structure.
Exactly. All the growth happens inside that tax-sheltered retirement account, potentially leading to massive long-term wealth accumulation without the drag of annual taxation.
That sounds incredibly powerful.
Yeah.
What are the key rules or maybe the biggest risks that an investor absolutely must be aware of when they start self-directing their retirement funds into real estate?
The biggest landmine is violating the IRS's prohibited transaction rules. Specifically, the self-dealing rules are critical.
Self-dealing,
Meaning you, your spouse, your kids, parents, certain disqualified persons cannot personally benefit from the asset held within the IRA before you reach retirement age and start taking legitimate distributions.
give me an example.
Well, the classic example is you cannot buy a beautiful beach house rental property with your IRA funds and then go vacation there yourself for free, or even pay rent to your own IRA to use it. That's self-dealing. Big penalty.
Okay, so the benefit has to accrue inside the retirement account, not to you personally today.
Correct. You also have to be vigilant about something called unrelated business taxable income, or UBI. This can sometimes be triggered, particularly if the IRA uses debt financing, like a non-recourse loan, to acquire a property. It's a complex area.
So it requires careful setup and ongoing compliance.
Definitely. It requires a dedicated, knowledgeable, self-directed custodian and often good advice from a CPA familiar with these rules. But the potential benefits, years or decades of tax-free or tax-deferred growth on real estate returns, are absolutely enormous for long-term wealth building.
Wow. Okay, we've covered a huge amount. The financial philosophy, the advanced negotiation tactics for creative deals, understanding the hurdles with professional lending, and these deep, proactive tax strategies. But, none of this works without the final piece of the puzzle, right? Which is execution and persistence.
You can have the most brilliant, creative financing plan on paper, the perfect tax structure,
Yeah.
but execution trumps absolutely everything. As Ralph Waldo Emerson famously said, an ounce of action is worth a ton of theory.
So true.
Successful execution means moving away from that common investor mistake of chasing unattainable perfection or letting one small setback completely derail the entire plan or even their entire investing career.
How do the high performers, the ones who really succeed with this, structure that action? How do they ensure they execute?
They focus intensely, but in bursts. The material suggests breaking down big goals into more manageable, shorter sprints, maybe focusing laser-like on just one or two key objectives within a 12-week period, like a quarter.
A 12-week year kind of concept.
Yeah, sort of, yeah. That forces you to prioritize ruthlessly and acknowledge that truth. A good plan executed today is far better than a perfect plan delayed until tomorrow. Perfection is the enemy of progress here.
Right.
The successful execution strategy isn't really about never slipping up or never making a mistake. It's about the speed of recovery. The breaking of a good habit, like making offers consistently, doesn't matter nearly as much if the reclaiming of that habit is fast.
So don't let one no or one bad week turn into a bad month or quitting altogether.
Exactly. That persistence, that resilience, that's what ultimately turns all this financial intelligence we've discussed into actual, tangible, accumulated wealth over time. #tag outro.
Well, we've completed a really massive deep dive today into creative financial intelligence for real estate investors. We moved way past the typical limitations of just relying on conventional bank financing.
Yeah, we started by prioritizing capital over consumption, understanding that fundamental mindset shift.
Then we got into how to maximize ROI through exponential leverage,
Yeah.
using powerful strategies like BRRRR.
And mastering negotiation, didn't we? Especially focusing on those seller financing terms and how to customize debt structures, even in complex multi-party deals.
Absolutely. And critically, we layered on the intentionality behind intelligent tax structuring, leveraging rental losses, maybe aiming for that real estate professional designation to protect high income.
And using those self-directed retirement funds to really fuel tax-free or tax-deferred growth over the long haul.
The reality is, and the sources confirm this, the financial environment, the real estate market, it's constantly changing, isn't it? It creates opportunities every single day, regardless of whether the headlines say the market is booming or, experiencing a dip.
That's so true. But those opportunities, they're really exclusively accessible to those who continually develop their financial intelligence, their knowledge, and
Wow.
as we've seen today, just as importantly, the persistence to actually act on that knowledge consistently.
So the ultimate final thought we want to leave you with today really connects those immediate gains you can get from creative financing to the longer-term necessity of personal resilience and adaptability.
You really must choose to welcome change, learn, and adapt new strategies rather than just clinging defensively to the outdated conventional past, maybe the way things were done 10 years ago.
Because the techniques we discussed today, they empower you to be more resourceful, more resilient, and ultimately ready for whatever the market delivers next.
So go put that ounce of action into practice.
We look forward to hearing about and maybe seeing what you acquire next.